As you plan for your retirement, there are so many questions that come to mind. Like, how much money can I withdraw from my investments when I retire? What is the most amount I can withdraw from my retirement accounts without running out of money? One of the most common answers is to use the 4% rule. Let's look at the origins of the 4% rule. The 4% rule was created using historical data on stock and bond returns over the 50-year period from 1926 to 1976. Before the early 1990s, experts generally considered 5% to be a safe amount for retirees to withdraw each year. Financial advisor William Bengen conducted an exhaustive study of historical returns in 1994, focusing heavily on the severe market downturns of the 1930s and the early 1970s. Bengen concluded that even during untenable markets, no historical case existed in which a 4% annual withdrawal exhausted a retirement portfolio in less than 33 years. How the 4% rule works. The 4% rule is easy to follow. In the first year of retirement, you can withdraw up to 4% of your portfolio's value. If you have $1 million saved for your retirement, for example, you could save $40,000 in the first year of retirement following the 4% rule. Beginning in year 2 of retirement, you adjust this amount by the rate of inflation. If inflation were 2%, for example, you could withdraw $40,800. In the rare case where the prices went down by say 2%, you would withdraw less than the previous year, that is $39,200. You can also use the 4% rule as a quick way to calculate how much savings you'll need to generate within a certain amount of income. Let's say you've determined that you'll need $60,000 a year from your savings to live comfortably in retirement. Based on the 4% rule, you'd divide $60,000 by 0.04 or simply multiply by 25 to determine that you'd need a nest egg of approximately $1.5 million to afford the lifestyle you want. Does it really work? It assumes that your investment portfolio contains about 50% stocks and 50% bonds, but your assets may be allocated differently. Investing more in bonds could result in slower investment growth because bonds typically don't see the returns that stocks do. And when the 4% rule was developed, bond interest rates were much higher than they are today. Following the 4% rule in this scenario could cause you to withdraw too much money too quickly. 4% rule does not work if a retiree violates the rule and withdraws more than they are supposed to, which causes the principal to be reduced and impacts the compound interest growth. Some say the rule isn't flexible enough to account for changing income needs. For example, people typically spend and travel more in the early years of retirement and have higher medical expenses later on. The best approach for retirees considering the rule might be to follow it, but also keep a close eye on their portfolios and make adjustments as needed for changing expenses and market conditions.